There are hundreds of thousands of trusts in the UK with hundreds of thousands of pounds invested in them. We'll have the latest statistics on how many trusts there are, how much is invested in them, what the capital gains are and what income they have when the Revenue HMRC publish their next statistics on trusts, which are scheduled to be published in July. However, those statistics, as they have been in the past, only cover trusts that submit a self-assessment return. And there are quite a number of trusts that won't submit a self-assessment return, not because they choose not to, because they don't have to, because the amounts that are generated under the trust don't, or the amounts that are in the trust don't require a trust self-assessment return to be submitted. So regardless of the number, the actual number of trusts that there are, if you want to be active in the trustee investment market, advising on trust investments, then it's important to at least have a working understanding of the law and the tax provisions applying to trust. That will be an absolute requirement for an effective collaboration that you'll want to have, I suspect, if you want to be seriously active in this market. That collaboration needs to be with who are the gatekeepers to this market, solicitors and accountants, probably with an emphasis on the former. They'll want to see and know and feel reassured in your understanding. Now, the collaboration that really works is one where you have legal, tax and financial planning expertise working together, with each having a working understanding of the expertise of the other, but not the actual expertise, of course. From a financial planner's standpoint, it's really positive that the law, the Trustee Act, in relation to trustee investment, requires trustees, with a couple of exceptions, but it requires them to seek advice from someone that the trustees reasonably believe to be qualified to give that advice. That doesn't refer to professional qualifications in investment, of course would help, but basically a financial planner who's been in the business for a while would definitely qualify as someone who the trustees reasonably believe, and that belief is important because getting the trust of the trustees through a demonstration of your knowledge and understanding of trust will be essential to have them reasonably believe that you are that person qualified to give advice on investment. Then you have, if you have the combination of someone qualified to give advice by virtue of their know-how in investments, someone qualified legally, and maybe someone qualified also on, but definitely someone qualified on the tax front, which may be the same person qualified on legal and tax issues, but definitely having an understanding of the tax provisions for trust, and that will drive undoubtedly the best client outcome. It's one of those areas where collaboration between the professions can be really, really effective. It's almost a requirement to deliver that perfect tax outcome, that perfect investment outcome for the trust. From a taxation standpoint, also from a financial planning standpoint, it's really important that the financial planner knows how trusts are taxed, and the taxation of trusts will depend on the type of trust that you're dealing with. If you're dealing with a bare trust, which will not be impossible, basically you're looking at the taxation provisions of the beneficiaries. It's almost a straight through, transparent approach to taxation with bare trust. With interest in possession trust, the income is effectively taxed on the persons entitled to the income. That's what an interest in possession is, by the way, current right to current income. And the capital gains at trust level, at least, are taxed at the trustee's rate, which will be the highest rate applicable to capital gains, 20% for most capital gains, 28% for gains on residential property, and if they had it, carried interest. And when it comes to discretionary trusts, they are almost discriminated against from a tax standpoint, because the tax system seems almost rigged against them, in that every flow is subject to tax at the highest possible rate. What does that mean? Well, it means quite simply, interest is taxed at 45%. By the way, trustees don't have a personal allowance and only have a half of the capital gains tax exemption that individuals have. So they have a standard rate band for income of £1,000, which is taxed at the standard rate, the basic rate. Once you get above that, and there's no dividend allowance, by the way, once you get above that amount, then interest is taxed at 45%, dividends are taxed at 38.1%, capital gains are taxed at 20%, rent is taxed at 45%. So the very worst of the tax world applies to discretionary trusts. So with the right know-how, understanding and expertise, certainly the know-how around how investments are taxed, you can look to potentially improve the tax outcome for existing trusts. But you'll only be really in a position to do that effectively through collaboration with other professionals. So I'd encourage you to just at least be, if you want to be active in this market, just have a working knowledge of the legal and tax provisions, which I've just talked about. All of that detail is present within Techlink under the Trustee Investment section.